Well, the idea is the American way is more, bigger, better, faster, stronger, right? That is the American way. So they want to own 10,000 units or 100,000 units, these syndications, when they really only own 2% or 5% of these, they don't own that much of these buildings, but they can say they own 10,000 units, right? It's a feather in their cap, right? That's an ego thing. Really, again, if we have 10 of us and we have 200 units that are all paid off, we're all doing pretty freaking well at the end of the day, right?
What's going on, Real Dealz podcast listeners? I am at you here with show 378. This week, I had an investor call. I do monthly investor calls. I just started it last month. But I have a lot of people that are looking to place capital. And so I started doing a monthly investor call to talk about the deals we have in our pipeline, to bring on other syndicators, people that are raising capital, such as like Brandon Turner, our buddy Artem Templar, and some other guys around the country that I know. And so what I'm going for is twofold. I am going for one, I am talking more about deals to people that are trying to invest. So I want to always be a couple steps ahead of them so I know how to answer their questions. But then we also go over deals that other people might have and things like that. So we broke down this week a deal from Brandon Turner that they put out. They funded it in 6 days. It was a 530 unit in Houston, Texas. Looked like a really good deal. I know some of the general partners were also putting money into this deal, funded in 6 days. I think they raised something like 20-some million dollars. So good for them. But we kind of broke it down, went through what my thoughts were on it. And then after that, we answered some Q&A from questions that had been sent from the last meeting and kind of went over those things. And I think there's some really good nuggets in here. So I recorded it and I'm putting it out the second half where they were doing more of the Q&A, because it's kind of hard to see because I'm going over a PDF web form. So it's kind of hard to see on a podcast. So I sent out the second half. I will upload the first half and the whole thing onto my YouTube channel. It's just Elliot Smith, REI. I am putting some of the stuff out there as well. So I think it's really good information. It's especially if you're raising capital, you're talking to private investors, you're trying to fund your deals, really having this conversation is something that you need to learn how to have it. I see a lot of people out there that are paying investors 10, 12, 14% plus points, and you really don't need to in this environment. Money needs a home, and money will go for a lesser yield. So we generally get 6 to 8%. I will pay 9% sometimes as well, depending on whose money it is. But I have people that I can make one phone call and say, hey, I need to fund this deal. It costs X. I want X. I can fund the rehab, or can you fund the rehab? And they'll say, sure, where do I wire the money to? So you have to build rapport with your investors. And it's a relationship, and you have to look after their money like you would your mother's money or your father's money or your sister's money. And so we talk a lot about in there of why I'm not pressing on deals, why we're not forcing deals, what kind of deals we're going after, what kind of deals are important to us, my thought processes on owning a lot of rentals versus, a handful of rentals that are paid for. So really, I think this is a lot of good information that you can use in your daily day-to-day business. So pretty excited about that show for you guys to hear it. What's going on with us this week? Short week with the holiday. We kind of got backed up a little bit, just normal business stuff, trying to get caught up. And then we are turning around really quick. I did work Monday, but it was kind of an off day because most people weren't working today. And then we're going again back up to Coeur d'Alene today to hang out with some friends for the weekend. Should be really, really enjoyable. Some of the guys that I met when I was in New York a couple weeks ago. And so, but Monty's going, Chris is going, the families are going. So it should be a really enjoyable time. Other than that, not much new here, other than we have a lot of maybes in our development pipeline. And so we're kind of drawing the marketing back just a touch because we got a lot of really good leads in there. And now it's time to kind of start working those leads and making sure that we can get the ones that are maybe, or some of the ones that we have under contract, to a stage where they can be maybe deals to then they can be to make money deals. So I talk about that in the show today, some of the stuff we have going on. Also, we are ramping up the marketing. We are basically finished building our lists For our multifamily, that's a process in itself because multifamily is sometimes harder to get a lot of the information when you're going on the bigger stuff. So we have a CoStar. We've gotten CoStar, so we got a lot of good information from there. And then I have my team going through, I broke it down to about 4,000 units, or not units, but properties. And now I have my team going through and filling out all the missing information, making sure we have the correct people to mail to, making sure we're building a file basically for each seller and each property so we can have a good understanding. Then what we'll do is we'll break it down into categories. So we're going from $2 to $12 million purchase price. And we are then breaking it down into 4 different categories. So we'll go premium, next level, premium, next level, and next level. So each level will get different types of marketing, and the premiums side, the top 10% will get more money spent on it on marketing than maybe the bottom half will, but they're all going to get, good amount of money spent per lead on there. So really, I think we're going to do really well with that, especially in Washington State with a lot of the stuff they're putting out. They've changed a lot of the rules. They're trying to get rid of any kind of evictions basically. And so that's been another thing that we've been working on this week as well, is trying to figure out where we're going to. They did lift the rent increase moratorium. So we did send out some rent increases this week. Didn't send it out to everybody because we don't want a ton of people moving out all at once. We wouldn't be able to handle the turnovers. So we're segmenting it, every month we're sending out rent increases. So then we're not just slammed with turnovers if that's what people want to do, because our rents are way, way below market value. So anyway, other than that, like I said, the second half of this will be, the first half actually will be on YouTube. That's something that you probably need to see visually. The second half is something really good to listen to. That will also be on YouTube, and you can see that visually as well. But that YouTube channel is Elliot Smith REI. It's the same as my Instagram account. And so hopefully you guys find value in this. This is something that will help you very, very much in your investing career and raising money from from private capital people. So you have to learn how to talk their language. A couple of things. They're scared. They don't want to lose their money. That's the first thing, is you need to tell them how they're not going to lose their money. And then how are you going to protect their money? And then what kind of return are they going to get? Most return is not always the most important thing. They just want some return, and they don't want you to lose their money. So protect their money at all costs. So a lot of these people are just making high incomes, or they have money sitting on the sidelines. They just need to do something with it. So a lot of times if you do a higher return, people equate higher 10, 12, 14% returns with risk. So the lower the return, they think it's less risky. And plus there's so much money out there, you don't need to pay that much interest right now. I think you guys are really going to like the show today. So really quick, we're going to listen to our sponsor, and then we're going to get into it. Stick around. All right. So a couple of things we're going over tonight. This meeting is being recorded. So we have a list I sent out to everybody of what we were talking about. And so we're going to talk about a syndication deal. It actually filled up today, but really just want to go over how we look at them, how I think about deals and thought processes there. That deal was a Brandon Turner deal that they've been raising quite a bit of money lately. And so that's a good opportunity if you have cash sitting on the sidelines to put money in a deal like that, if you want to get something in play right away. If you want to be more patient, then and wait for our stuff, that's great as well. But we want to make sure we're giving you all the opportunities in the world to get your money working for you. We'll talk a little bit about our current pipeline and the struggles and challenges that we have, and what were the wins we have. We'll talk a few questions that Richard asked me after the last meeting. And we'll talk about why being patient with our capital is important. If we have some time, we will go over the 25 unit that we just closed on in May, and talk about the numbers that were actuals versus what we projected and think they can be, and kind of go from there, and what it would look like if somebody invested in that deal, if we kind of raise money for that deal. So I will go ahead and start out with going over the Cypress Point deal from Brandon Turner's stuff. So I'm going to share my screen. All right. So this is really well done and put together. This is a legit, full on fund. Bigger funds like this, your returns might be less, they might be more, but they're putting in a lot bigger properties that are going to take quite a bit of time. They need a lot of capital, and there's a lot of people to spread things out on. So first thing is, this is in Houston, Texas. It's a 530 unit Class B property.
So Open Door Capital is Brandon Turner's investment company. They do mainly mobile home parks, but what he's getting right now is he's getting guys like Disrupt Equity partners that are bringing him deals and having him basically raise money for deals because he's a very good fundraiser. So we try to get him on tonight, but he blocks Tuesdays out. I will be doing a call with him, just going over some deals. This one fully funded today, but they do have another one coming up. I do get first look at these deals before they go out to the open market. So I will try to get him on and we can talk about the new deal coming up so people can look at that. Usually the minimums are 50 to 75K. This one was 75K on this deal. So I'm going to run through this. It's 51 pages. So I'm not going to go super deep into every single page, but I'm going to kind of look and kind of talk about how they structured this and why they did this very well.
Elliot, does Brandon Turner vet these deals, or does he just?
He does. He does vet them. Their whole team vets them. So they have their whole capital management, Open Door Capital, that vets them. They actually go. He actually flies to look at the deals himself. Their whole team vets them as well. They don't just put their name behind it and raise money. Okay. So they're actually partners in the deal. So they're part of the general partnership side, and they're also this one they're investing money in. So they're actually in the limited partner side as well. So overview, sponsorship team. These are just pictures of the property. They'll talk about everything they have going. So they'll have their disclaimer, financial disclaimer. Most funds are going to be 506Bs or 506Cs. So it's usually only open to accredited investors, which that is $250,000 a year. Richard, right? 200, yeah, I think so. 200, 250, or $1 million net worth.
Yeah.
Outside of your primary residence.
Correct.
So these guys are with the Disrupt. This is Brandon and his team. This is his co-founders. So they're partners on this. This is their team that they have on there. So we'll kind of go executive summary. So this property, once we dive in, this one was hit in the last hurricane when they had the huge hurricane in Houston. So that is something to consider. They have an average household income in the area of 132,000 within a 1 mile radius. Then Houston, a lot of people are moving to Houston, so they have a good high prediction of population increase and predictions of a 9% rent increase. Those are great. We'll see. Rents are up quite a bit year over year in Tri-Cities. Rents are up a lot more than 9% in Tri-Cities. We have properties that are probably increasing rents 20 to 30% this year on the cycle through.
Question. And you might not know the answer, Elliot, but it said $40 million in recent renovations I was like, by the math, I think it was like 300 units. So
yeah, 310 units.
Yeah, that's like almost like $100-something thousand per unit.
Yeah, seems like a lot, huh?
It seems like a lot.
But they also, you have to remember a hurricane came through. So that's probably, they had to do probably a lot of exterior. They probably had to do roofs. They probably had to do a ton of things that, like, if the hurricane just flood damage, they probably had flood damage. They probably had a lot of issues that cost a lot more money. So one thing these guys are not going to do on these things is they're not going to lie. They're not going to they won't, I think, because they can get sued really easily if you fib these numbers, right? Mm-hmm. $129,000 a unit, which we can build stuff for cheaper than that in Tri-Cities. So the other thing in Texas, the property taxes are usually pretty high. So they're targeting a cash on cash return of 8.5 to 9.5% annualized, or cash return, and then annual return of 15 to 19%. That's pretty generalized for everything. Most guys are going to slap that on there. But this one, they are doing an 8% preferred return. As we learned last month with Artem, there's anywhere from like a 6 to 8% usually is where that preferred return lies. So they are on the higher percent of preferred return on this, which is always interesting to me of why, if they're strongly believe in the upside, why is the preferred return on the higher side? But just a thought there. They plan to refinance in 3 years upon stabilization. They think they can increase the rents 115 to 350. They have a good team, GP team. The general partnerships team is going to put $2 million of their own money into the deal, which means that they believe in the deal. And then located in Houston, estimated rehab budget for both interior exterior improvements of the asset, which seems pretty light to me, seeing how they just did 310 units and there's 220 units left.
Yeah, that was going to be my next question to them. I was like, yeah, for 220 units, you're putting not a ton of money in.
Yeah. So one thing that we found out with our apartments, so we have a 24 unit that we bought last June. So we were just over a year that we've owned it. And then we just bought the 25 unit Poland. Then we have an 8 unit. 8 unit was stabilized. The 24 unit that we bought over off Entiat, it's 1025 Entiat. The idea was rents were extremely low. They're average of like $600. We're up to we're getting up to $850 now, but we had a lot of tenants that were really low. Everybody says, oh, refinance the project in 3 years upon stabilization. It's a lot of work to stabilize these properties. It is a pain in the ass. We have not made money on the 24 unit yet. Now we've made money in equity gains because we've increased our net operating income, but we're not making money because we're putting everything back in the building, having to turn over units after units after units and losing rent when people are moving out. So that's easier said than done is those things. So 530 units, average market rents, kind of go through those things. I don't dive in that deep to it. The units that they've updated are pretty nice. So it'll be interesting to see how they do the new units, the other 220 for less. Yeah, for $2.5 million, because that bathroom's probably costing you to do this. If you're doing anything close like that, you're probably $2,500 to $3,500 just for the bathroom. That kitchen's probably a $10,000 kitchen. That going from here to this is probably, I don't know, another $10,000 to $15,000. So that adds up really quickly if they're going to be doing those things. And we'll dive, and that's why we're going over this together. We'll dive in and see what they say. So there's the unit mix. Unit mix is pretty good. I would say that's a pretty good unit mix. A lot more 2 bedrooms. You're going to want more of those. You always want your 1 bedroom, 1 bath, but your 2 bedroom, 2 bath, works for more people. Here's the floor plans right there. And again, you guys all got this in the email, so you can go over it yourself as well. Here's the exterior. You can tell that they did a lot of exterior. The renovations on the outside look really nice. Mm-hmm. So that's where they probably spent a bunch of money on these things, the gym, all this stuff. I mean, you can see the wood in here. It's not a slummy place. It's definitely very nice. You can see where 40 million can get spent pretty easy if they had to do all this stuff again. Here's the occupancy rate of apartments in the area. So they're saying they're $130 below comps. Effective range. Occupancy is right in line though with everything else. Rent comparables. This is what they're breaking down. There's their deltas between everything for their 3 bedrooms or 2 bedrooms and their 1 bedrooms. This is just showing where theirs is compared to the other properties. Okay, really big site. The one thing that I would look at if I'm looking at this right now is I want to go drive this area. So if I go and pull this address, so we're on page 23, I would go through and see, we'll go Google Maps. So I'm going to go in here. Okay. So I want to drive this area. So I'm going to go over here, and then I'm going to also go, and I just want to put my pin right here, and I want to start driving streets. So what does the neighborhood look like? Are people taking care of their stuff? Is it a good area? Because I'm not flying to Houston to look at this deal. So are people taking care of their properties? This street looks pretty good. Okay. Just looks like a decent middle class area. I would say it looks pretty decent. If I go back, let's go on the other side of the tracks, go over here, because you want to look at every point, because streets matter. Again, pretty nice. Looks like a pretty nice area. So you can justify and say, okay, they're saying 132,000 a year median income. You can justify saying, okay, this is a nice area. So people are going to live here. It's not, a slumlord area. So we'll go back to 23. Okay. Just a site map where it's at, things in the area. Nearby education, talks about education that's around, some of the things that are close. One thing always, Starbucks coffee is a really good indicator. Starbucks if you're building something and they're putting a Starbucks in, you should feel pretty safe. Starbucks does a really good job spending a bunch of money on research to make sure the people that live there can spend $5 on a cup of coffee. And so there's one here, one here, one here, one here, one here. There's a lot of people in that area that can spend money on coffee. So that's always a good indicator. Here's some shopping by. So looks like a nice area. Okay. This just goes over their rent growth and their employment and things like that. So you guys can dive into that a little bit more. So this talks about who they are, 3,000 plus units under management, which sounds like a lot, but at the end of the day, is that with Brandon Turner's company and Disrupt, or is that just with Disrupt, the people that are going to be managing this? This is a 530 unit. So that's almost nearly 15% of a 3,000 unit portfolio. So that's a big jump. When they always say over 50 years of property management experience, Randy, Richard, and I could probably say we have over 15 years of management experience because we've owned rentals. So take that with a grain of salt always. They do have other assets in Houston. So their loan terms are going to get a $41 million loan, 3.5% interest only. They're probably doing a Freddie Mac kind of loan. That's a very standard loan on bigger properties, interest only loans, 3-year term, 2-year plus 2 1-year extensions. The concern I have on this is 5 years is really short. We just locked into a 10-year term loan with a 10-year floating rate, a 30-year AM, and 2 years of interest only at 3.92%. There's a lot of things that are going to change in the next 5 years. So I would not be liking to refi out of this in 5 years, in my opinion, on an asset this big. That would be my concern if interest rates change a lot in the next 3 to 5 years when they start jumping them up with the inflation worries we have. Because 100 basis points one way makes a big difference on a loan this size. 8% preferred return, and they're going to take out 25 to 40% of the cash out in 3 years projected on stabilization. Doesn't seem like a ton, so it doesn't seem like they're buying this with a ton of equity in the deal. I'd like to pull out more cash out of my deals than that, but still not a bad deal. This is their debt structuring. They're talking about number of closed transactions. This is the guy of the financing, so he's closed a lot of deals. Here's where their budget goes. And this is where we would have the same question, Richard, is unit upgrades. There's 220 units, and they're only spending $1 million a unit to do that. So if we just take that.
Yeah, I just don't know how you get quartz plus nice.
If that's what they're doing, if that's their idea. But you would think that if you're going to match the property, you would match that. But if you go $1 million divided by 220 units, that's only $4,500 a unit. That's about $20,000 less than we thought. So roofs, that seems like a lot for roofs. You would think that if they spent $40 million on the rehab after a hurricane, the roofs are probably screwed up. You'd think that they would have put roofs on there.
Yeah.
Woodwork, paint, parking lot, things like that. Okay. That seems light to me, but let's go with what we see. So this sample return is based off on $1 million investment. So years one, they're saying that they're going to have economic vacancy. That's probably from doing turnovers is what I'm thinking of how they're breaking that down. Rent escalators, 3% rent escalators. So they're saying distributions, they'll distribute 31% to the LPs in the first year. So you'll get 3.2% return on your money. So you would make $3,200 if you put $100,000 in the year one, 7.9%. So 79,000. So you'd make $7,900 the next year. Then this third year is where they're talking about their refi. So they're going to pull out 29% of your cash back to you. So, so if let's go with $1 million, 291,000, and at 10% cash on distributions. And then they run it out for 7 years. So they're saying return of capital from sale. They think they'll make you $700,000 on your $1 million from the sale. Their profit from sale, well, you'll return your capital because you've already got this back right here. So there's your $1 million. I think you'll make $635,000. So your total cash flow would be $1,415,000 is what they're projecting. That's with return of capital. So 41%. If I'm doing my math right. So I think this is a decent deal. I think it's average though. honestly, when you get in these big syndications like this, I think it'll probably be a higher return than what they're projecting. You always want to project low and go average and go high. But I just think if you're sticking $100,000 here, you're sticking $100,000 here, and you just need to get some money in a deal, sure, this deal works. But these are the ones that you just set it and forget it. And, you know, you get quarterly updates and call it a good day. Here's their fee structure. So we talked about this last month with Artem as well. So they're saying they're going to give you preferred return, which means LPs will get 8% preferred return before the GPs take anything. So they can't take anything off the table, any of their profit off the table until there's been an 8% return paid back. They're charging a 3% property management fee, which seems okay to me. And if we go, let's see what their cash is, what they're saying on cash flow. Where's their cash? So they have how many units? Where's the unit one? So average, so they have average of 530 units. So they have effective rent of 574 a month. Clear. So 574, let's just do rough numbers, times 12, 6.88 million. So times 0.03%. So they're charging $206,000 a year for property management. Seems kind of low to me, unless it seems like a low figure. That $200,000 doesn't get you a lot of people for 530 units. So we're right here. Asset management fee, that's just people managing money, getting money to place capital. Acquisitions fee, 2%, seems fair. Capital transaction fee, that's just another fee for raising capital. So this is how guys take profit before they have to pay you your preferred return. That's how they take profit off these deals.
When do they normally pay that, Elliot?
What's that?
When do they normally play that cumulative 8%? Or is it just ongoing per year?
That's a yearly return. That's how they, but it's like as you saw in the first thing where they said they're only going to give out 3.2%. They're saying over the life of the project, before they take any capital, you'll get your 8% preferred return a year. Mm-hmm. So that's where they'll push that through. That makes sense. So like the first year they give 3.2% back to you. They still aren't taking any profit on the deal yet, because they haven't given you your 8%.
These are just the kind of working expenses, right? So like these are still viewed as working expenses.
Yeah.
And then can we go back to the previous slide real quickly?
Yep.
The sensitivity analysis.
Okay.
Yeah, perfect. Right there. The question I had to ask you regarding the return metrics, they're just talking about the return, right? Like in terms of like the return metrics, on the right side, return metrics as compared to reversion cap rate. They're just talking about the return depending on what the cap rate is.
Yes, correct. Yeah, because they're underwriting at a 5.5 cap. So they think if they get it to a 5.2 or the market goes at a 5 or 4.75, that's where their average annualized return will be. So that's why they're basing it right here. But if the cap rates go down, which cap rates will go up in inflation in an environment where interest rates are rising. So say interest rates are rising in the year 5 and they need to refi out year 3 to 5, and cap rates go up because interest rates went up, their average annualized return will be lower. Okay. So right now in Tri-Cities, we're seeing anywhere from I think I can sell apartments at 5.5, depending on if they're brand new, let's say renovated apartments that are fully running really well. I think they can be a 5.5, anywhere from 5 to 6, let's say, apartments that need work. I want to be in there at a 7 to an 8.5, probably. Brand new apartments, you're probably at a 4.5, 4.75. Thanks for asking that. So this is where they take money. So this will get paid out when they buy it. So they're raising capital to pay the acquisitions fee, the 1% fee. They'll pay these fees for the first year. And then those will be yearly. These two will be yearly fees, the 5%. So that's how they do take some money out of the deal. And then here's how much they're raising. So they're raising $22 million for it. Total purchase price of $57 million. Renovation, closing costs and fees there. Reserves and repairs, 4.2 million. They're saying that they give management team is giving 25% of their asset management fee to charity. I think that's great that people do that, but I don't understand where that has a place, in the deal. I think that could be afterwards, but I think it just is something to get people excited. This shows some of their track records and dispositions. So they've done really well from what it looks like. Investor and net return has been really, really good on the ones they've sold. So I think they know what they're doing. I think this is, if I had money, I would put money in this deal. And the reason I probably just my $100,000 sitting in the sidelines that I didn't have any place to place it, I'd probably put money in a deal like this. Because it's just good to spread your risk. Growing with guys like this and having money in different deals all over the country, it really insulates you in a lot of respects. I know guys like Ken McElroy, have done really well for other people. I know people that have invested in his deals. So you're just not going to see, you're going to pay more to get in these deals, I think, than you would in something like ours. And you're getting people that are higher up bigger in the food chain, and you might not see as much increased upside with somebody like you would with us. So, but I don't think it's a bad deal. So they'll do monthly distributions, investor updates, and open communication. And then here's some questions they have about oil and gas, increasing expenses and things like that. So you guys can kind of go over that. Also, they're going to do a cost segregation for bonus appreciation. If you're not real estate professional, that doesn't really help you too much. So that is that one. So again, they have another one coming up. We can talk about that. I'll send out a video to everybody when that comes up. Try to get that out earlier so you have more time to look at it. These deals do fund really quickly though. This 6 days to raise the $20 million for this deal. So there's a lot of dry powder, people looking for cash, put cash somewhere.
I have a question to ask you. So from their perspective, why do so many syndications want to sell out 5-10 years, like that time frame?
It's just where they're annualized. That's where it just seems to work. That's just where their returns, like they start getting stagnant, I think, if they hold them for quite a bit longer.
I think if you run the IRR analysis on these apartments, they kind of start the rate of return, internal rate of return just starts plateauing.
Yeah.
Around somewhere between year 5 and year 10. And these guys have to kind of justify their fees, so they just keep finding different deals, right?
Yeah.
I think they make more for themselves by acquiring the deals, not holding them.
Yeah.
Syndicators make money. They're just moving money. They're just trying to move money in assets, right? And they're trying to run those assets. Now you can make a ton of money in these deals, but that's why they're willing to give up such a big piece of the pie, because they're just trying to place capital. They're going to take their 2% acquisition fee. They're going to take their asset management fee. They're going to take their capital placement fee. This deal only has 5 or 6 guys in the deal, 4 or 5 guys in the general partnership side. You start adding those fees up. It's a lot of money. And so then they need to move capital as quickly as possible, because that is how they generate more money. So we have a little bit same thought process on our deals. I want to be out of Washington in the next 5 to 7 years if things continue to go the way they're going with, just the policies that are in place. Really, the idea that we have in my mind is, how do I get enough assets in multifamily, and something that we're really good at, and take those and then 1031 them, if it's still there, into something that's like a triple net commercial, something commercial that's more insulated, like, a long-term lease on an Amazon, fulfillment factory, a FedEx factory, shipping center, where they're doing like the last mile delivery, things like that, things that are going to be a lot more insulated, in a probably less liberal state. So, really, I just want to I want to grow my capital as much as I can right now, take $5, $10, $15 million, leverage that into something else that's worth $20, $30, $40 million. It just spits cash. to a certain extent, or place it in a lot of different things that, you know, that are triple net, that are more set it and forget it. It's kind of the thought process, but that's where we're at. So, all right, that is that one. I'm going to go back to what the next thing. So our current pipeline, Rudd sent me a text about where we're at in Benton City. We are, by the way, our prices look good for Richard for our 13 unit starting to come down.
That's good.
So just got our topo maps today for that development for all those lots. Now we're going for a zoning change and an updated plat map. And so we're doing well. We came to an agreement with the other property owner to double the development out there in Benton City. That's the 60 lot subdivision. So we went from like 24 lots to go to 60. We're going to try to get a zone change to get the density a little bit better. So we're working on that one. We also are talking with the cities in Benton City for the apartment complex that we have the 3 plots tied up that we're going to build. I think we can build an 18 unit possibly, but for sure like a 14 unit. So we're looking at that, and we're going to go for the 18 unit because we can go high. The property sits kind of on a little slope, but we can build off the back. We can kind of build like daylight basement kind of deal where people come around and back park. We think we can go 4 stories high on that. And so that could be good. The issues that we're running into, and I know this is where people get frustrated because they want to put capital in and it's just kind of, you know, takes the fire out of it. The cities are backed up extremely so far. Before COVID, in Kennewick, the city of Kennewick, it would take 3 to 5 months to go from deal to pre-approved to moving dirt. They're now at 14 to 18 months. And that's in Kennewick. So we're fighting this on all fronts. We have another deal in Pasco that we're working on that came from our marketing. That's 10 acres that we're looking. It's in West Pasco, and we're just getting pushback after pushback, and it's a very slow process. So it just is very, very slow. And it's hard for somebody like my personality who comes from the flipping world, that's instant gratification, that wants to move deals and put money in place. And I feel the pressure, but it just is a patient waiting game. That's why if you need to place capital, I'm going to show you deals every month or operators that if you need to place capital today, go place it with them. So I don't, in the meantime, but just know you lock your money away with those guys when you do that. But most of you guys are continuing to make more money, so it's okay. The idea that we have, I'm going to jump one down. So talk about being patient with your capital is important. This is not the time to rush capital placement. This is a time to be very patient and wait. Yes, you might be losing money to inflation. Yes, you could be getting a return. But if you get into a bad deal right now, you're going to lose a lot more stress, sleep, and capital than if you were just patient. If you set your money in a simple IRA fund, a mutual fund or something, and let it sit there while you're waiting, that maybe hopefully keeps up with the rate of inflation, that's an option. We do have some lots that we're going to be building. Rudd's going to be building stuff out. We can get your capital in play and things like that when we start building. It's going to be more of a one-off deal. We also have a full marketing campaign going for all apartments from 2 to 12 million in the state of Washington. We should be launching that marketing campaign next week with very, very high quality mailers. We are very good at that. So we should have more of those deals. Those are existing deals, apartments that we're going to be looking at buying and placing capital in those deals. And we will be raising money for those. So be patient. I don't feel pressure. I don't want to feel pressure to place your capital, because if I do that, mistakes happen. So we'll just keep going, and money will always be there. And we'll just keep doing these every month for you guys to watch them. But it is important to be patient right now. So Richard had a few questions from the last one. Details of deal structuring and financing. How does it change with equity amount? So, and will we present an investment opportunity? Yeah, we'll present an investment opportunity, and I'll kind of go over a thought process when we go over and dive into our deal that we bought last month. And if we were to raise capital for that, how we would have looked at it. But it's going to be different on deal to deal basis. Obvious, we want everybody to win. So, depending on where we're buying the property, we might give more to the LPs. If I think I'm getting a smoking deal, then I might come down closer to 50-50 where everybody's still really winning. But really, we want to make sure that we're taking care of all the limited partners and try to be very consistent on your returns and go from there. So things will change from deal to deal. Also, buy and hold will be different. From development will be different to buy and build and hold will be different, and trying to find the most advantageous tax strategies to keep capital and not pay as much taxes on those things. Details of the loan terms, duration, financing costs. So I can talk about the loan terms for like when we would pull properties out, but loan terms for if you're just making a straight loan, we will on like a build and things, we will give you a full build out of draw time. The idea is you don't want to give us too much money, but you don't want to give us too little money because we want to keep as much money at working as possible, paying you interest at that point. But we will have timeframes in there. Just know there is supply chain issues, so timeframes could vary greatly. So we will, whenever we underwrite a deal, we will pencil in extra timeframes to make sure that we're penciling that in and the project still works with interest being paid. If you are lending on, like say you're buying a lot for us or something like that, and we have to go get bank financing to build something, you will at that point have to subordinate to the bank. We will at certain levels personally guarantee. I'll probably personally guarantee a lot of the money on those deals. I can't speak for Rudd's buildings that houses he's building, but a lot of the stuff that I'm involved in, I will personally guarantee the money that I borrow. If I have to sell everything off and pay everybody back, I will sell everything off. So I want to protect your capital. That is number one. So we would send that out. If you don't fully fund the project, how do we become subordinate? You basically just subordinate to the projects, the bank money that we get, or somebody that has to be in first position. So you just subordinate, you'd be second, and we go from there.
In terms of that question, I think the person was saying hypothetically, if you're looking at like investors like us, right? Like just random people, what if we came up with 80% of the money, or like let's say like we came up with 40% of, say you needed $1 million and we only came up with 250. The other 750 comes in from other investors, right? Would they be?
That was the next question. That's on the next question.
Okay.
Yeah. So that one's a little bit different. So there's two different ways on that. Let's take the first one would be like, we're doing a build, like you're going to loan me money and I need to go to a bank to get the rest of the money. You would automatically subordinate. So there is different levels of where the debt comes in, and who gets paid back first. Banks are going to always be in first position. Then you guys would be, if we had to bring some other person there, and then limited partners would be there. And then general partners would be the next one up. So it goes bank debt, first position, mezzanine debt. This is for like raising for syndication. Mezzanine debt would be like seconds, seller carryback seconds, things like that. Then limited partners, and then Elliot, the general partnership team. Now, if you guys fund 30%, we find another 70%. And who are you treated the same as the other 70% of the investors? So the other limited partners, you are treated exactly the same. How in my mind, this works is, say we received $1 million and I borrowed $2 million from limited partners. So that I got $1 million back in the deal. That $1 million, and I have 10 investors. All 10 investors would get $100,000. Everybody would be equal at that point. It's not going to be first money in, first money out. It would be equal to everybody because we want everybody to raise together. So nobody in the limited partnership would be treated any differently than the other people. Make sense?
Mm-hmm.
So IRR, cash flow, cash and cash return projections for investors, and project level. Can you give a rough idea? Different category investment. I will send out a chart on this, but basically if you lend money on a simple interest loan, it's 8%. That's annualized year over year. We want to keep it working all through the year. If you only give me money for 6 months and it's 8%, you're really only getting 4% of that money if it's not working. So we want to make sure we don't want to pay too much because I'm going to go to cheaper debt. So we want to be right in line with everybody else. We can get debt from anywhere from 6 to 10%. is really what it can be. So 8% is right in the middle there. And I want to make sure I'm keeping the money working. If we were doing a development deal, that's going to be a deal by deal basis. That's going to be a lot higher returns because there's more risk to that. So those returns, I would have to project those out on the deal itself. If you're coming in as a partnership, as like a syndication partnership. On the apartments, if say we go buy an apartment, the idea I would have on those would be a 50-50 limited partner to a general partnership. You guys would probably bring the investors would probably bring majority of the cash in for the down payment. We would help fund reserves and things like that. We would, depending on the deal and how much equity you're gaining on the deal, is how much money we would want to put in the deal ourselves. So then we would probably, only thing we would take would be an acquisitions fee. And it would probably be something very reasonable just to cover our overhead and cover our marketing costs for getting those deals, to continue getting that. And then we would just charge back costs on the property. So any management fees, maintenance, repairs, things like that, we would just charge those back at cost. We don't need to make money on those things. We don't need to make money on management or anything like that. And that would be very transparent. We would probably be at a 6% preferred return is probably where we would shoot at for a cash on cash preferred return, but our annualized will be a lot higher. Now we will probably say it's going to be in the 15 to 18% return range, but I will be shooting for quite a bit higher, and I will dive in and show you where that works in the deal when we go over that next deal. So waterfall, how's waterfall change percentage of equity and performance of an investment? That's going to be a deal by deal basis. So, and waterfalls, I'm not as fully read up on how the waterfall clauses change things, but that would be a deal by deal basis that we would write into the contract. Buy and hold or sale holding period. Some of us want to buy and hold instead of on investments for long haul. I do too. Honestly, if we could have 100 or 200 units fully paid off, we're sitting pretty good at the end of the day. So I don't need to be like those guys that have 3,000 plus doors. I don't need to have that much. I don't need to be that leveraged. The idea would be if we can get a group of people that really want to just buy a bunch of properties, pay them down. Maybe we keep them leveraged at 50% LTV. We can move that cash into other deals. Great. Or if we want to have properties that are paid off, that sounds great too. I mean, really, I can live really well off 40 paid units, paid off houses. I can probably live a pretty good lifestyle. And so for right now, we still have properties that my wife bought when she was 20 that we haven't sold. Now our return on equity is lower, but we're about to pay it off, and then I can tap that equity if I need to, but I don't need to at this point. So we don't need to sell it because it still cash flows really well. Why sell things when we already have assets that are performing? Would you agree with that, Richard?
Yeah, that's always like my frustration when I like listen to Bigger Pockets, right? Like people are like, oh, you have a paid off property that's like terrible. And I'm like, well, there's no risk and I can always leverage it.
You can always leverage it.
I can always leverage it and then like change my like return. Like it's not that big of a deal.
Well, the idea is the American way is more, bigger, better, faster, stronger, right? That is the American way. So they want to own 10,000 units or 100,000 units, these syndications, when they really only own 2% or 5% of these, they don't own that much of these buildings, but they can say they own 10,000 units, right? It's a feather in their cap, right? That's an ego thing. Really, again, if we have 10 of us and we have 200 units that are all paid off, we're all doing pretty freaking well at the end of the day, right? That's the idea. And if we want to recapitalize, we can sell off our underperforming assets that might be in a fringe C area and go put it into more of an A, B area. Take that. So then we take a property. The idea would be, say we have a property that's paid off. Take that and we have a ton of equity. Go put that in a A-class apartment complex and put 50% down. Roll it all into the property. And then we have an A-class property that takes, a lot better care of. It's a lot less maintenance overhead and pain in the ass. That's
what I've always thought. But like, yeah, that's why like I'm always surprised that these syndication people I understand that they need to make money on all their, like, they're just moving money to make money, right?
Correct.
But like, I've always thought like it would just be great to like build like a 200 unit complex in Bellevue. where you're charging like,
if you build a 200 unit complex in Bellevue, you're in the $1 billion range, half $500 million range of buildings. So,
okay, maybe Bellevue's not like,
we need a few more doctors.
Yeah. A-class property, and then just like sitting on the like cash flow from there.
Correct. Now there is something to be said of opportunity cost for money though. So if we tie up our money and we run out of money to have opportunity, we always want to make sure we have powder dry and opportunity when things come across. That's why I go back to, I don't press, because if I put money in a bad deal, I lose opportunity cost. And that's the idea. Randy's invested with me for what, 3 years now, Randy?
Probably more.
4 years. And I never press deals. We never push, right? But the deals we do, they're good, really good deals.
Yeah.
So that's kind of thought there. Exit strategy, that's going to be based on what the group collectively decides, I think, to a certain point, and what we just talked about. Percentage of sponsor equity, how much are you putting into each deal? Or on the flip side, what is your take percentage of the profit? It's going to go deal by deal. I kind of talked over that a little bit, but we'll probably look at a 50-50 on most existing building buy and holds, things like that. That's what we'll probably look at, 50-50 LP, GP. You guys will probably fund most of the down payment. Getting into the property, we'll run the management. We find the deal, we run the management, you guys bring the money. Each deal needs 3 parts: money, operators, and the deal. If we'll bring 2 out of the 3 parts, and you guys bring the other third, and we'll split it 50-50. So you guys are getting good upside. Impact of inflation. So we invest now or wait. Construction cost looks to be coming down. So I think I just watched a video today about pending home sales are declining sharper and sooner than they have in 19 and 18 and historically. So I think this is a very unsure time. A lot of the jobs being added are entry-level service sector jobs coming back, not a ton of money. The opportunity right now is in affordable housing. That's why we're so bullish on Benton City. I'm so bullish on apartments, building apartments here locally in Tri-Cities. Affordable housing is important. I don't want to be, I don't want to be stuck doing a 60 lot subdivision with $700,000 houses right now. That's not where I want to be. Now, one-offs that Rudd has, from here and there, or 5 or 10. Okay. I think you can cover those pretty well. You can insulate yourself pretty well there, but I think being patient right now is probably the best thing you can do with your money. That's what we're doing with our money.
Sorry. I think the question also had to relate to like interest rates. You said like if interest rates go up like a percentage point or 2 percentage points over the next 2 to 5 years. And if we had bought something and then, we're going to refinance, like we have to potentially refinance, or there's an arm or something like that. Or if we wait 3 years, if the interest rates go up, like say 5%, I mean, like it's something crazy, right? Would there be a significant drop in the price at that point in time? 5 years. I mean, granted, you would have had to sit on cash for 5 years. There will be a drop in price, but it's going to balance each other out with your cap rate. Will balance it out with what you're paying in a mortgage rate. The idea right now is we want to lock in long-term debt now, and we want to lock in as long as we can. So Randy and I did a deal, the 8 unit, it was under $1 million loan. So we had to go with a credit union. It's a 5-year term and 5-year resets. Now it's a 30-year amortization loan, but we have to reset every 5 years. So we need to really pay attention to that. The deals, the reason we're going after deals that are $2 million to $2 to $12 million is we can do a Freddie Mac product can be a 10-year term, 2-year interest only, 3-year interest only in prime markets, sometimes up to 10 years interest only. So your cash flow is really, really good, but we wouldn't want to do it too long because we want some debt pay down. But the idea is we want to push that can down as far as we can. The other thing with Freddie Mac product is that the loans are assumable. So you have an asset right there in that property. So say interest rates go to 6%, right? And we have a 3.95% mortgage first position that is assumable. That is a valuable asset right there, because then we can sell that note and we can do a seller carryback second or whatever. We can get money for the second or whatever it is. So if there's 5 years left on the term, they're going to buy that note. They want to be in that position because interest rates are so much lower on that. So really, does that make sense, Richard? So if you got a 4% interest rate now, 2 years from now, 2 years later, it goes up to 6%. Interest rates go up to 6%. Who's buying the 4% note?
So say somebody want to sell the building. Say we want to sell the building. We need to sell it for whatever reason, right?
Yeah.
That mortgage is assumable.
Oh, so you can sell it to somebody and say, hey, part of the deal is
you just take over my 4% mortgage, right? It's like so that loan's assumable for a 1% fee. So that's why we're searching in that area. Worst case scenario, explain what the worst case scenarios are for different projects, or are they all the same in syndication as it pertains to an investor? Worst case is we lose all our money. I mean, I don't think that happens, but the worst case is you are investing. Now, the idea that you're going to lose all your money is very slim to none. We're buying assets. We're buying things that have intrinsic value. You can't go rebuild them for X amount of costs. Now, say we have another COVID thing and it wipes out half the population. Well, those assets are going to be worth a lot less. That looks very slim of happening. But the riskier deals will be the development deals. Those are the ones that are riskier because you're buying dirt that has some value, but it has more value if we put streets, pipes, and houses on it. But in order to get it to be that more valuable spot, we have to spend a bunch of money to put streets, pipes, and houses on it. So things happen in that timeline because it's such a long time frame. That's why I'd be more cautious on higher priced, subdivisions as I would be on entry level subdivisions. Worst case, if say we get stuck with a subdivision, then we do a 60 unit entry level housing subdivision, which this actually could be best case because I actually want to keep a lot of these houses personally. But worst case is that we plan to sell them. Well, and we can't sell them, but there's still people that need to live. So we rent them out. And we build in enough buffer with our pricing that we still have a lot of room to still get loans at 80%, 75% LTV, where we can still get loans, where we still get majority, if not all of our cash back out at that point. That would be the idea. So why invest with me? You guys are looking at platforms like, there are syndicators that we talked about today, or looking at people like CrowdStreet and things like that. So the difference between somebody like me and a CrowdStreet or a syndicator is, we kind of talked a little bit about it, is they're taking a ton of fees. They're taking a lot of fees in the deal. They're having to place capital. They need to go place capital. They are going to get usually lower returns than what I would project that we get. They're up here, and we're the kids that are biting at their heels trying to grow up to a certain level. So we need capital too. But we're going to have to give a little bit more of our deals away because we don't have as big of a track record as them. The CrowdStreet platforms, those are fine in a way that, you should get a decent return, but there's also a lot of people in that deal that have to make money. CrowdStreet, the operators, the guys that are, all these different people have to make money. We're cutting that out. And so that money is going back to the collective. Also, the question I have on CrowdStreet, if the deal is so good, why are you having to go to a platform like CrowdStreet to raise capital? You're just checking the easy button at some point, but why don't you? I've had investors growing up since we started in this business the entire time, and I've grown more and more investors as I've gone, and I've never lost an investor. So why don't people that are putting together 530 unit deals, why don't they have an investor pipeline like that? Why are they having to go to CrowdStreet? Why are these guys that are doing the 530 unit in Houston having to go to a Brandon Turner to go and then go raise capital? Those are questions that I would ask for that. Lastly, we're here. We want to have fun. We want to build a community of people like we talked about earlier. If we just own 200 doors free and clear, that's really cool. For example, 2 weeks, about a month ago, we had a tenant die in our property. He was dead in there for a couple of days. There was a hoarder. It was a hoarder. It was really gross. We want to send that out to you guys and say, so you're going to talk about it to your buddies, and you can see it. It's in Washington. Hopefully the deals are mainly all in Washington. They're in Tri-Cities. You can see them. You can touch them. You can feel them. You can drive to them within 3 hours. You can talk about them to the deals with your buddies. We'll update you on fun things that are going on and keep you involved in the sense where you feel like you're connected to this deal. And it's different than just putting money into a deal and saying, okay, I'll see a quarterly, sheet every month, every quarter. We want let you experience this because it's fun. Real estate investing is fun. And I know when I worked a job at Franz, all I could think about is doing fun stuff because Franz was monotonous and wasn't that fun. And so doing real estate is fun. It's exciting. It gets you out of your comfort zone a little bit. And it's the same reason I invest in stocks. I don't do it to make money. I just do it because it's fun. And I want to have conversational pieces with other people when I can talk about those things. So that would be why I would say investing with us is some good points. But again, I'm going to give you operators from all over the country and give you opportunities to invest your money with other people because really I want to do what's best for you guys. I never have a fear of being able to raise money for deals. I know I can raise money if the deal's right in a minute. And so we just want to give you guys as much opportunity as possible because building wealth in real estate is probably one of the greatest tools you can have. I think it's going to outperform so many other assets unless you're really aggressive in your stocks. And I think it's something that you can actually touch and feel. You know, real estate dropped quite a bit in 2008, but apartments didn't drop that much in value, but stocks and bonds and retirements sure dropped a lot. And even if they drop 50% in value, because for whatever reason, if we still have tenants in there, we're still getting monthly cash flow. It's like a dividend paying stock. And it doesn't turn off unless somehow we lose 50% of our tenants. And if we're in good areas and entry level price points, I find that highly unlikely that we would do that. That would happen. So that's that. Cool. Do you guys want to run through the other deal really quick, or you want to call it at that? The one that we did, that we already bought, and kind of just give you an idea, or do you want me to do a separate video and I can send that out later?
I think you can send that out later.
Yeah.
Okay. Pretty standard stuff, right?
Yeah, it's pretty standard.
Yeah.
So anyway, I will be working on doing a video. If I can get him on live in the evening, I will send out an invite to people if they want to join with Brandon and I, so they can hop on and listen. But I will be sending the video out of that. We should hopefully be hopping on here in the next couple of weeks. I'm hanging out this week with Ken McElroy. I might try to talk him into doing a video with me as well. And then also next month, I will have a different operator on, hopefully Ken or somebody like that, that we can dive into the deals that they're doing and opportunities they may have coming up in the future. And then hopefully we'll have more traction and stuff going on our stuff here locally.
I mean, I feel like those big syndications, they're just all over the place. I get pitched them all, those kind of stuff all the time, but I just feel like when it's all said and done, your returns are so low. I don't really.
Yeah. So the idea that I have, Randy, and we can go a different direction, that's fine. The idea I have is I want people to look at different asset classes and start to be able to understand different asset classes and different investment opportunities. Right. And really, because I want people to make confident decisions when they invest with me. And so I want them, if they can get a little bit more knowledge, they can make more confident decisions on deals that when we present deals and going forward.
Right. Okay.
That would be my thought process. And I'm fine to change it and make these.
No, I think that makes sense. I think I don't want to speak for Richard, but the reason Richard and I are here is because we're willing to spend a little bit more time, but we want something better than we're looking for things that's just better than the mass syndication deals, right?
I agree. I don't want to pitch syndication deals either. That's not my idea. My idea is that we have deals in the pipeline to put money in. But if I don't have any deals, I want to give everybody options too. If they have money burning a hole in their pocket.
Right. Okay.
So I just want to,
we're all sitting on more cash than we like, but like you said, patience is key in today's environment, right?
Yeah. I mean, just with 5 guys that I can name off the top of my head right now, a couple of them sitting here, I mean, we can go do some damage. I mean, we can go do some damage. We can go get a pretty good deal. And my team is actively, we have hired an executive assistant. We have hired, I have a full-time sales manager. I have an assistant for my sales manager. I partner with Greg Lynch on the West Side as well for finding deals. They have a full sales team on it. We are actively looking for buy and hold real estate. And then we're also here in the Tri-Cities looking for development deals and build and hold. So, but it just takes a while for me to build this machine up because I'm also working that call center as well. So, but my time is getting pushed back more towards this. And so I expect these things to come, but again, I won't press. I won't push deals.
Cool.
Yeah, I think it's just like kind of like a waiting thing. Like, cause I don't like, yeah, cause like the backstory, Randy, is like Elliot came to me with like this deal and I was like, I don't have that much money, but I can ask some people and see if they're interested. And then long story short, it didn't come through, but people are like, hey, are we going to do something? Yes or no? We kind of set up an LLC. And I was like, well, if we want to put some money in play, I can ask Elliot for some other ideas if you really want to put some money into the market. But I'm kind of like you, I don't want to really invest in syndication unless I have to. Like, I kind of want to control the real estate, if that makes sense. And I don't have to control it, right? It could be through Elliot, or it could be like, if it could be through a partnership. But I just feel like I'm like another step removed from the syndication, if that makes sense.
You're 50 steps. You're so many steps. You're not calling Brandon Turner. Yeah, you're not calling Brandon Turner and being like, hey, what's going on with this syndication? Or Brian Murray or the guys running it. You know what I mean? You get what you get from them, you know.
Like, they want to have it, like I could sit down and talk to you at like in 3 years and we're like, okay, like this is what we're thinking. And I was like, okay, well, you know, what if I want to keep it or something? Like, let's try to
exactly. Yeah. So say I want to sell out in 3 years and you're like, your group says, hey, we want to keep it. Okay. How do we structure that?
Right.
You know, how do we do that? You know, we had a commercial building that we own in downtown Pasco. My buddy brought us the deal that we're building a 13 unit on. And he was also, he was a third owner in that with us as well. We wanted to get out of the commercial building. We had 60,000 of our own cash. We funded the cash part of it when we bought it 2 years ago. He's like, how about we just give you your 60 grand back and swap equity in Dealz and call it a good day? Absolutely. I want to get out of this deal. You don't want to do this one because you don't want to be spread too thin. Give me my money back. Let's swap equity. Easy day. Everybody's happy. So that happens when you do these, you know, work with guys like us, that you're one phone call away. So,
but yeah. And from my perspective, yeah, like, cause I don't see very many deals. Like, I'm not actively looking for stuff, right? Like, it's different. And so like,
yeah. So Lily, do you have any questions?
No, I'm good.
That was a test though. That means you were listening because you answered really quickly. So, all right. Well, I will send this out. Thanks for joining tonight, Lily. And we'll go end it there, guys.